Welcome to the big show. It's the Retire Young radio show. If you're a first-time listener, thanks for stopping by. I am your host, Joshua David, and we are happy to have you with us today. As always, I have my great friend, my great pal, and he's a pretty smart dude, Mr. Al Connickson. Al, how the heck are you doing today?
I'm doing really well. Actually, I'm now starting my diet so I can load up again next Thanksgiving.
Here, I thought you've been dieting all this time.
No, it takes me all year to get to the point where I feel I can load up on Thanksgiving, but then I have to spend the next year losing what I just gained. It's a cycle that just repeats every year.
And it's always great to be back helping our Retire Young family make those better investing decisions. Al, we have a phenomenal show on tap today. In the past couple weeks here, week and a half or so, we've had some all-time highs once again. The Dow hit that 30,000 back on, I think it was the 24th
right?
of November. See, I got Spanish there, don't I?
That's pretty classy.
So, there's a lot going on with these markets. We're seeing some major moves, all-time highs. And there is also down moves within these all-time highs. So today what I want to talk about is how the average investor can participate no matter which way this market goes, because there's up markets, there is down markets. There's a term called shorting we're going to talk about, and that's a way of participating in a down market. But before we do that, let's recap what's going on and help our listeners get involved in these phenomenal markets.
Yeah, well, the markets have been on fire. It's been sort of like an early Christmas present for a lot of us. And there's really been kind of a tug of war, and we have mentioned this before, between the coronavirus news and then the vaccine news. And we've got several companies now that are reporting pretty good results with their vaccines. So that's really what I think has helped to propel the market upward. The election results are, that's kind of behind us now. And the interesting thing about the markets, Josh, is that news or events really have kind of a short-term effect. There might be an immediate blip up or immediate blip down when something comes out, but then after a short period of time, we get back into how the markets function on a regular basis. And Tesla finally made the S&P 500.
Woohoo!
Yeah, woohoo is right. So everybody holding Tesla stock was pretty happy, including Elon Musk, who moved into the second richest person in the world position. Tesla really, it's not just an auto company. It actually has become a pretty good technology company.
Yeah.
It wouldn't surprise me at all if very shortly, if you have a Tesla and you miss a payment, the car will drive itself back to the dealer.
It's a possibility.
That's a possibility.
What's really great is some of these other companies are bringing these electric vehicles out too.
Absolutely.
GM has that vehicle.
Yep.
Have you seen that Hummer?
Yeah, absolutely.
That's a nice looking
it's
vehicle.
Great. And there's some new companies coming out too, companies that most people hadn't heard of before. So it's an interesting component of the market, and a lot of things will be happening there. But we always talk about opportunity, Josh. The key word really is opportunity.
Yep.
And the market's providing opportunities both for short-term traders and for long-term investors. This is a great time, regardless of whether you were just looking at taking care of immediate needs or really kind of boosting the value and the growth of your wealth portfolio. But the important thing is how to take advantage of the opportunities. And really, it's proper preparation. I've quoted, I believe it's Henry Ford that said this. Hopefully, if I'm wrong, somebody will let me know. He said that success is when preparation meets opportunity. So why is preparation so important? Well, the truth is we don't really know anything for sure. To be honest, no one knows exactly with 100% certainty which way a trade or investment is going to go. The good news is we can do things to increase the probability that we're right and decrease the probability that we're wrong. And the primary way of doing that, very simply, is to think, act, and execute like the pros, like the smart money. Those are the big Wall Street firms, the big hedge fund managers, maybe some individuals. Warren Buffett always comes to mind. Mm-hmm. But why would you want to do that? Well, there's two sides to every transaction. And typically it's the smart money on one side and the public on the other side, because the smart money, the institutions control probably somewhere between 70 to almost 90% of the transactions in the market, which means that there's a pretty good chance that as the public, you're on the other side. You don't want to compete with those people. You can't, but you can join them.
That's a common thing, is people think they have to compete with that smart money.
Right. No, it's the great thing for us is that they're actually kind of telegraphing what they're going to be doing So we don't have to compete with them. We can just go right along with them. It's basically, following in the footsteps of the people that know what they're doing. And they're consistently doing very well. The institutions are, Goldman Sachs, JP Morgan. If you look at their returns over, go back 10, 20 years and look at the number of wins compared to losses, but more importantly, the value of their wins compared to the losses. And it shows a couple of things. Number one, they know how to protect what they have, and they also know how to participate in different directions in the market. Because we talk about this all the time. The market does not just go up. And for most of the people probably listening to the show, if you're in mutual funds or in stocks, you are probably in a strategy or a portfolio strategy that only is going to benefit you if the market goes up, if
That's
the value of those things go up. Right. And if there's three different directions, you're only participating in one out of three opportunities. That's low probability. One way you increase the probabilities is to be able to participate in up, down, and sideways markets. And then also understand how to protect your capital. That's huge. Also, the institutions use different assets than actually they have their clients using. And we'll talk more about those specifically in that next segment. And then also, all of these smart money players, they follow a plan. They have a plan that really takes their emotions out of the trading decision. And that's really what you should do as an individual trader or investor. It's one of the things that we have all of our students do is have a plan specific to them.
It's amazing that, the markets have three directions, but the common person or the average investor, the public, is only participating in one direction, and that's up. So there's opportunities that are missed there. So you want to trade like the smart money. The smart money they're participating in up markets. They're taking profits in down markets, but they're also doing that in sideways markets too. But here's a good thing is they telegraph what they do. Everything that, as a proper trader or investor, you want to base your decisions off a price chart. And when institutions are moving millions and billions of dollars, they telegraph it, or you can see that on a price chart based on the explosive moves that they're showing. Big show coming up. We're going to talk more about that down market and how the smart money has created income. We'll be right back.